Good afternoon, ladies and gentlemen. I'm here today as an advisor from JP Morgan. Good afternoon, ladies and gentlemen. I'm here today as an advisor from JP Morgan. My name is Mackenzie Whale, and I'm going to be talking to you about my recommendation of what you should do with your Flight Centre shares. I'll also be talking about how Flight Centre's DCF and relative valuations impact on whether you should buy, sell, or hold your Flight Centre shares. Lastly, I will discuss the current state of the travel industry around the world at this time, and the current state of Flight Centre as a whole company in comparison. The company Flight Centre that I will be discussing with you today is one of the biggest travel groups in the world. It has business operations in 23 countries. Additionally, Flight Centre is a massive company that has a massive company under its conglomerate called Corporate Traveller that networks throughout 90 countries around the world. It is the objective of Flight Centre to become the largest and most successful corporate traveller company by having business operations in more than 50 countries and 80,000 employees based around the world by the year 2035. As you can see from this table, market capitalisation for Flight Centre is $3,468 million, and the market cap is $2,270 million. This shows that Flight Centre is a very liquid company, so if they were to experience a downturn in the market, they would have the liquidity to ride it out. Also, the future forecast of Flight Centre is that revenue has been increasing since 2019, where it was $3,066 million. It is expected to rise to $3,083 million by the end of the financial year of 2020 and continue in 2021 to $3,224 and $3,316 million in 2022. This shows reason as to why to buy Flight Centre shares, as they are forecast to have incrementally larger revenue growth over the next 4 years. However, the current stock price is $34.40 and the price target is $37. The PBT margin is falling below 1%, which isn't meeting the target of 2% that Flight Centre has set as a goal. This shows targets aren't being met. Revenue margins have been falling due to online ticket booking and more competitive within the travel industry, which has eroded the ability for Flight Centre to charge service fees. Regardless that Flight Centre isn't meeting its growth targets, the stock price is currently lower than what it should be, according to JP Morgan report. And therefore, it is recommended that the share is bought. Reinforcing a major reason why Flight Centre shares should be bought is the positive earnings Corporate Traveller. Positive earnings Corporate Traveller has shown in this financial year to date in new growth areas such as the United States of America, which it will increase revenue and market share as it is only currently 5%. Another reason to buy Flight Centre shares is due to the upgrade to the new CDS global distribution system, which has caused a downturn in the Australian leisure system, but due to it now being complete, Flight Centre will now see a rise in productivity, sales staff, and will result in a more advantageous numbers. Also, Flight Centre's enterprise bargaining agreement has been ratified, which has resulted in the direction of the company as we move back to cost cutting and growth of Flight Centre, which is where it used to be. Even though targets haven't been met regarding growth, the strong financial data and the company's leadership position in the market makes investing in Flight Centre desirable and very opportunistic. At this current stage in time, the virus COVID-19 has caused a drop in confidence slightly within society, which has caused uncertainty for Flight Centre as a whole company. This is due to the fears that the virus may spread around the world and cause massive lockdowns as it has in China. Additionally, the increase in competitors and ease of booking online means decreases in sales, and scandals such as the 2018 underpay can also frighten off investors. A DCF valuation was done in order to fund the value of investing in Flight Centre. To fund the DCF, you fund the present value of the expected cash flows, discounted at a WACC of 8.5%, taking into account the terminal growth rate of 2%. As you can see from this slide, by finding the firm value and value over equity, you can discover the value per share, which is $105.19. According to the valuation, Flight Centre is undervalued as it trades at a share price of $34.40, based on Flight Centre's FCFF. This information is useful when deciding to whether to buy or sell Flight Centre shares, because the stock is undervalued, which means the financial risk is reduced and profit increased. This is a positive result when wanting to invest in a stock like Flight Centre. Moving on to relative valuation. By comparing Flight Centre's financial data to that of its peers in its industry, a conclusion can be made as to whether to buy, hold, or sell shares. As we can see from the high price to earnings ratio and earnings per share, the company is in a strong financial position. The price to sales dividend per share, profit before tax, and enterprise value are all indicating strong profits. Demand and stability. Competitors such as Expedia and Core Travel Management highlight industry average. Flight Centre has the highest PDE, suggesting a competitive advantage over peers. Its earnings per share and price to sales is at the industry average. Its earnings per share would benefit from being slightly higher to remain the strongest competitor. This all leads to the fact that Flight Centre shares should be bought based on the DCF and relative valuation analysis. This is because they are undervalued. I believe the additional reasoning that I advise that you buy Flight Centre shares is due to the impact that the coronavirus fears have had on the share price, which has caused the share price to slightly fall. The recommendation is also solidified through the potential expansion opportunities Flight Centre have planned, their leadership position in the industry. Through buying this stock, it presents an opportunity to go long and make a less risky profit. In conclusion, through conducting valuations and intensive research on the current and future financial position of the company, Flight Centre shares are undervalued and present an opportunity for active and passive investors. This concludes my stock pitch today. Thank you.